In this video, I'm going to show you how to take tax efficient wages and dividends out of your limited company. Hi there, my name is Simon Misiewicz from Optimise Accountants, and as the intro suggested, I'm going to show you how to take money out of your limited company in the most tax efficient way. We're going to be focusing on your wages and on dividends that you take from the company. But there are some things you need to be aware of, so we need to dive into the details now of how you can take those wages and dividends in the most tax efficient way, but be law abiding as well. Alright, so let's get into the details now of how you can take out money from your limited company. And we need to be aware of a couple of things, but let's get into the details and let's see what you can do. So as it says here, we're going to take out tax efficient wages and dividends from your limited company. How do we do that? Well, before we do go into the detail, if you want to reference HMRC's own literature, here's the screenshots that I have used from our own video, and I've provided you with the link as well, so make sure that you go into that website to get more details as you see fit. Now, before we talk about limited companies and should you set one up, by the way, I have created a video all about Section 24 and limited companies, so go ahead and watch that video of how to take money as a limited company, or indeed should you even set one up at all. But this is an example, a classic example of where we need to compare the income tax versus corporation tax. And you'll notice on the first column we've got in your own name. So let's imagine that you've got taxable profits of £100,000. I have purposely ignored Section 24 because that is a total nightmare, which I don't want to go into the details of in terms of how the tax is calculated. So what I've done is that if you earn £100,000, ignoring Section 24, you are likely to have a tax bill of around about £27,500. However, if you set up a limited company and all you do is want to extract as much money from that company as possible, then you will notice, I'm hoping anyway, that you'll pay more tax of £29,238 than if you left all of your assets and drive that income into your own name. So why set up a limited company at all? Well, I'm glad you asked that question, because really limited company structures only work well if you've got multiple people as shareholders, or indeed you're happy to reinvest that money. So let's go through another example then, whereby someone's not wanting to take out all of the money to support their lifestyle. This is whereby someone, instead of taking out the maximum £83,000 after corporation tax, they simply take out £50,000, which in effect is half of what the profits are made, before tax of course. Now, when you do that, you've got your corporation tax of £17,000, you've got £2,663, which is personal income tax, but hopefully you will notice that if you set up a limited company without extracting all of the money, then your tax liability in total is just under £20,000, compared to if the assets that generated that income was in your sole name of £27,500. The key difference, and the reason why this is happening, by the way, is because HMRC will attack that £100,000 in your own name, as opposed to £50,000 being left in the limited company, which is then reinvested for investment purposes. So hopefully you can see now in terms of should you or should you not set up a limited company to be tax efficient. So I've created an online portal where it'll help you to understand how you can save SDLT when you're buying a property, value added tax when you're buying a commercial building or indeed refurbishing a property, the income tax and corporation tax that you can save when making profits on your property portfolio. So make sure you enroll today and start learning how you can save tax on your property portfolio. And what I want to do now is talk about the best way of taking wages and dividends out of your limited company. And we should know by 2021 you have a basic allowance of £12,500, which basically means you can earn £12,500 and you would suffer no tax at all. So no income tax on your £12,500. There are some other benefits, and I'm going to go into that in a little bit more detail. But let's first start off with saying that you can take out wages and dividends, which comes up to your personal allowance. Now, we do need to bear in mind that dividends can only be taken out of your limited company provided that you are making profits. If you're making a loss, no dividends, unfortunately. No dividends at all. So you would have to rely on your wages, which may not be working for you. However, saying that, if you have got profits, then you would take out wages of 8632 and then dividends of 3868. And that comes up to your personal allowance. Now, is that it? That's a short video if that's the case. Well, no, unfortunately not. Because I need you to also look at this other website from the HMRC.gov, which talks about running payroll. Many videos out there will talk about extracting wages, but they may not go into the detail of RTI. And what does RTI stand for? It stands for real-time information. So real-time information is a requirement for you as a company to submit data to HMRC for payroll purposes. And that really kicks in because RTI is a requirement when you pay someone of £118 or more per week, which is equivalent to 6136, so £6,136 per year. Now, as you may have just alluded to, that we've got wages of now 8632 to be taken out of your limited company. And I said that there are no national insurance charges and there are no income tax issues. But we still need to provide HMRC with real-time information every month to say that we've paid ourselves this 118 per week or more. But there may be a threshold where you don't pay national insurance. So if you pay yourself, let's say £7,000, you still got to do RTI. It's just that you are telling RTI that you have no national insurance liabilities or income tax liabilities. So why do it at all? I don't know, but that's just the requirement of HMRC. Unfortunately, I'm just the messenger. Don't shoot me right now because I'm just passing you that information of what you need to do. So if you are wanting to take out wages of 8632, please make sure that you look at the HMRC guidance on real-time information and see if you need to submit that report to them on a monthly basis. That aside, I did say if you take out wages and dividends up to your personal allowance, there is an additional benefit. What is it? Well, I'm glad you asked because you are able to take out a further £2,000 worth of dividends out of your limited company, which is tax-free. So if you take your £12,500 personal allowance plus your £2,000 worth of dividends, you've guessed it, you've now got a new personal allowance of £14,500, which will be free from any tax at all. So if you've got a husband and wife arrangement, that gives you £29,000 for household income, which is not going to be subject to tax, income tax that is, or indeed national insurance. So great news there. Again, if you want further information on dividends, because you may be sitting here saying, well, that's fair enough, but £29,000 for a household income is not enough for me, or my wife, or my spouse, or civil partner. And that's fair enough. So this is a great website for you to go to understand what your dividends tax rates will be. But I've got the summary just here. So that's the detail. Here is the summary. So as I mentioned before, you can take between £0 and £2,000 worth of dividends, and that will be tax-free, 0%. You've got a basic rate tax band, so if you're earning less than kind of £50,000-ish, then you will be taxed at £2,000. So let's say that you want to, if your total taxable income of £30,000, you want to take out £10,000 of dividends, that would be taxed at 7.5%. Once you become a high rate taxpayer, wow, the tax rate really does increase from 7.5% to 32.5%, which is a shocking amount of money. And if you think about it, your company's already been taxed at 17%. Adding on this 32.5%, boy oh boy, you've now got 49.5%. Nearly 50% of your earnings will be subject to tax, whether corporation or income tax. And this is why I always say that for high rate taxpayers, you've got to be careful of using limited companies, because you could be taxed more in a company structure than you can if you had the earnings just in your personal name. As additional rate taxpayers, you know that you pay 45% income tax rates. Well, the dividend tax rate is 37.5%. So again, a heck of a lot of money, which then puts you above the 50% tax rate combined with corporation and income tax rates. So a lot of money again on dividends. If you do have any questions, make sure you fire those questions in the comments box below this video, and I will get back to you as soon as humanly possible. I do want to talk about other things. So the one big thing that people miss out on is pension contributions. So pension contributions is a huge thing. Why? Well, the benefit of a pension is the fact that it sits outside of your inheritance tax liability, and the company itself can get a reduction on the contributions it makes towards its taxable profit. Again, if you want more information on pensions, then feel free to look at your private pension contributions, and that URL is showing on my screen now. I will attempt to put them all in my description box as well, so that you can have a look at those quite easily. As I mentioned, we want to reduce corporation tax. So we may have a company that's £100,000, and you may be looking at my percentage here thinking corporation tax is 19%. This is a wrong video. Actually, this is forecasting forward. So we're looking at April 2020, where the tax rate for corporations is 17% instead of 19%. So it's coming down 2%. Hooray! If Labour gets in, it's going to go up. Boo! So we do need to be mindful now that corporation tax rate under the Tory government will be 17%. This is not a political rant, by the way, just in case you thought it was. But the corporation tax rate will be 17% unless things change politically, which means that you've got £83,000 left from your £100,000. Now, how can you reduce it? I mentioned pension contributions. So let's imagine that you are a single person, you've not had any pension contributions from your employer. Well, why not contribute from your own limited company? You can have £40,000. It may be adjusted for your personal circumstances, and that's why I said you need to look at the government website to find out more about that. But let's imagine that your company has got £100,000 worth of profit. It puts in £40,000 towards your pension. The adjusted net profit is now £60,000, which is then falling to $10,200 in terms of the tax it has to pay, which is a nice 7,000-ish tax saving it is made by contributing to your pension. So great deal. Let's not also forget that you can all go back a few tax years as well. So if you wanted to, you could wipe out that £100,000 in one foul swoop by putting it into your pension contributions. So a great type of investment there for you. Again, if you have any questions, make sure you fire those in the video box below, and I will get back to you. If you enjoyed this video and you want to talk about our services, then you could do so by visiting our website www.optimizeaccountants.co.uk, and you can then book a call to discuss our services. Or indeed, if you want to book a 60-minute slot with me, Simon Misiewicz, the co-owner of Optimise, then you can do so. You can use the code YouTube25 to get your 25% discount off your 60-minute tax consultation. Don't forget, guys, if you are going to be booking tax consultations with me, then you can upload your questions in advance, so we're talking about just the solutions on that call. Again, my name is Simon Misiewicz from Optimise. I look forward to seeing you on the next video.